Tech companies, from chip makers to device giants like Apple, sit directly in the line of fire coming from the trade war. So it's probably a good idea for investors to be checking their tech sector allocations right about now. To talk more about this, we're joined by Jason Ware, partner and chief investment officer at Albion Financial Group. That would be a good thing to know, Jason, exactly where the most vulnerable companies, if these tariffs do go on, which is which and which isn't. Because there have been some people point out with rates this low, it might not necessarily be a bad thing for some stocks, yield stocks or something. How do you see it bifurcating from here?
Well, so I think if you have a short-term lens, paying attention to what's happening with trade or what's happening with China is something that might dictate how you approach these stocks. But, we take a bigger picture, longer-term view. These are still secular growth stories that are dominating the markets in which they operate. They have strong business fundamentals, and we like to evaluate each on their own merit. I mean, they're all unique companies with unique assets, with unique management teams, and we still think that they have a place in one's portfolio if you take a long-term view and you realize that this is still Tech 2.0 in today's world.
All right. Do you have? Can you give us some details on how we should adjust our portfolios right now, Jason? What do you think?
Well, again, if you're a long-term investor, you shouldn't be adjusting your portfolios. If you don't own these stocks,
let's say you don't want to. If this really gets out of hand, where are the most vulnerable places?
We're the most vulnerable places in technology or among FAANG, just to clarify.
Go either. Just go across the board.
Well, certainly semiconductors have a lot of exposure to China. So I think if we see trade go sideways, they have more to lose than, say, a Google, which doesn't really operate in China. So you can certainly go through individual names and find exposure. That's fairly easy to say, what's the exposure to China? Oh, trade war is a problem, therefore I don't want to own that. But again, I don't think that's a robust analysis. So our view is to take a bigger picture view, look at what's happening globally, look at what's happening within their markets and how these businesses are operating and pick accordingly. And then also, like you said, valuation is important. A lot of these leading technology stocks in FAANG aren't trading at expensive valuations. Amazon, for example, is trading at 45 times forward earnings. That's fairly cheap relative to its history, and it's a secular growth story in e-commerce and cloud. So that's how we evaluate this.
So, Jason, when I think about it, I'm a global investor. I want some technology exposure. It's obvious. We know the answer, you and I. The only place is the U.S. that you're going to get that technology exposure. There seems to be dispersion where investors, not like 2018, have to run straight for the FAANGs. There's other areas in technology where you're able to get proper exposure. But walk me through how I should be thinking about the buyback story, in particular as we see corporations seeing a relaxation in borrowing costs. They're able to issue debt, as Apple has done over the last couple of years. Right. Alphabet is committed to increasing their buyback. Are we going to see a significant acceleration because of the Fed actions over the next 6 to 9 months, which be specific to technology?
No, I think that's a great point, and we very much could. I mean, these are cash-rich companies that, the bathtub is filling up quicker than the drain is going out in terms of free cash flow. So they have a lot of capital, and as we look at the businesses that we want to own, we want management teams that are good stewards of our capital. And looking at buybacks, looking at dividends, Apple's a great example, as you mentioned. I mean, this is probably the best capital returns program on the planet coming from Tim Cook and co. So as shareholders, we certainly celebrate that and want to be owners there. Google's been increasing their buyback. So there's a lot to like about cash return to shareholders with these large technology companies. Meanwhile, we want to be clear. We want to make sure we're seeing these companies still investing for the future. We want to see them doing strategic M&A. We want to see them investing in R&D. And all of these companies are growing their percentage of R&D relative to sales. So those are good things. But again, to your point, interest rates are low. So if you're going to take on some debt, some cheap financing to buy back stock, if it's attractively valued, and that's key, we don't want management overpaying on buybacks. I think that's a good strategy and something investors should look to as a component to their investment thesis.